Hello everyone, Christian Evans from Sanktuary here. Today we're going to have a look at a topic that is quite controversial, and it's basically breakouts, and more specifically range breakouts. What we're going to specifically look at is the reason why so many retail traders and investors consistently lose money trading this strategy, and how best to position yourselves when looking for opportunities of this sort. Now, this video is for educational purposes, and we are not independent financial advisors, so we're not providing any advice here as what you should go into the market and do. We're purely giving you examples and a framework by which to continue your own learning. Now, breakouts is something that is close to my heart in terms of a mistake that I kept making in my own professional career early on. It was one of those things that I really had to work hard on and understand as part of my learning curve. So hopefully through this video and the information we provide, we'll be able to kind of improve your learning curve and get you over this hurdle that so many people fail to do. So basically, before we start, I'd like to just quickly say a few words. Basically, if you haven't had a chance to have a look at our website, please do. There is a link in the description, and it's visited via www.sanctuary.co.uk. Basically just gives a bit of an outline of what we do, what we're all about, services we provide, and kind of allow you to see our views on different opportunities and markets there. So right at the bottom you have got our contact page. If you do want to have any queries, questions, want a bit more information, anything like that, please do fill this form. It says here we will reply within 24 hours of receipt, but to be quite honest with you, even if I'm laying in bed at 3 in the morning, which I often do awake, I will reply. So it's one of those whereby you could have a reply within 24 hours as the maximum, or you could have a reply within 3 minutes. So please do have a quick look there. It will prompt you as soon as you go onto the website for your first time as to whether you want to receive our monthly performance newsletter. Now, this is just going to be a 2-page A4 document every month, basically outlining a bit more about the business, the opportunities we've looked at, any business development and opportunities that we've kind of been looking into, and we'll also make a bit of a reference to the videos that we're uploading on YouTube too. This is only for us. We're only going to be providing you with this resource every month. We're not going to be selling you information on to third parties or spamming you or anything like that. So please do have a quick look there. Also, we do have a blog post. Now, this business blog is all about different aspects of the financial sector that we find interesting, and we trying to kind of upload 1 or 2 posts per week. It's been going for about 2 weeks. We've had quite a good response there. So please do check that out at www.sanctuary.co.uk, and that one is /blog. Okay, so basically what we're going to be looking at today is more specifically range breakouts. Now, there is going to be a follow-up video to this, which is going to be talking about channel breakouts and other technical patterns, but the way to explain them is going to be slightly different. So I think it'll be too rushed and too basic and almost vague if we were to put all of those into one short 15-minute video. Okay, so basically what we have here is an example of a range. Now, people trade ranges within their own right, kind of as a strategy on their own. But the important thing to know here is the trend that's preceding the range. Now, as you can see here, that's not good. We'll have that in orange. The important thing to know here is that the trend is bearish. So the market is moving downwards. Now, the market's moved down, it's turned to some arbitrary point. As we know, markets ebb and flow, kind of just lets do its own thing. It's retraced, it's bounced a couple of times, and these blue arrows here signify the turning points there. Now, at this point here is where we'll be looking to actually draw our range, because you need 2 points in order to draw a line. So you've got the first point here, first point for the upper line, and second. So we draw those lines, we have our range. So what you have here is kind of we're moving forward, and the red line is where our analysis starts. The market's done a couple of bounces. As the trend progresses, there's a higher probability that the range is going to finish and kind of not be withstanding anymore. On the flip side, as the range continues, because of it being support and resistance bound, the more significant those support and resistance levels are, those regions are. So basically, what we're saying is, the further along we go, the more likely that a breakout is likely to occur, but on the flip side, the support and resistance regions are stronger. So that's kind of almost counterintuitive. The important thing to note is that if you have a breakout after many bounces on a range, expect the move to be more significant. So what we're going to look at here are two different options and kind of ways to look at breakouts, option A and option B. So option A is basically when the market just kind of almost explodes and just moves in the trajectory shown to the upside. So what a lot of novice traders do and investors do is that they will look to do the simplest thing possible, and usually the thing that's kind of most marketed, most explained, most known about are usually the things that don't work based on terms of probabilities and as part of a good trading strategy. Kind of look at the statistics. 90 to 97% of traders consistently lose money, and it's funny how everyone seems to know about trading range breakouts. So what people tend to do is that they will just put their stop entry orders either side of the support and resistance regions. Now the reason they do that is because if the market goes in the direction that they want, they get filled, and if the move is aggressive, they don't miss it, and also because of the aggression by which it in the direction that it moves, it's almost like a safe haven whereby, because the prices are moving away from their entry price, they're in profit. It's that feeling of not needing to worry about a position that's around break even or even tinkering into loss. You don't need to stare at your screen so much. So people just place their stop entry orders either side, and the problem is that as soon as a market, in this example option A, occurs, the market will explode. So imagine now there's going to be a couple of range traders here who are actually going to be trading the range solely on their own. So they're not looking for any breakout. They just want the range to continue as much as possible so they can just take a couple of pips there based on selling at resistance, buying at support, and just kind of repeating stop and reverse and exit and reverse and exit and reversing all the way around there. So kind of just buying support and then selling double at a resistance and then buying double and kind of switching your position that way. So at these stop entry orders, they kind of get into the market, they expect the market to explode, but unfortunately it doesn't always happen. Now, if it does happen, it's great. The market just explodes, moves in the direction, you can pull your stop to break even, or you can just take profits, whatever it is. However, research has shown that the majority of breakouts that occur are actually fake outs. They don't actually withstand in that respect. And the reason is because of volume. So what you tend to find on these situations is that the volume isn't there, so there's not enough buyers to override the number of sellers that are at these resistance regions. Also, a number of people actually place stop entry orders way too close to a resistance region in this example. But as we've said before, support and resistance is a region. It's not so much an individual price. So you can't, you've got to kind of give a little bit of a room for error there, not solely just based on your drawing of your technical lines, for example, but others as well. And everyone's got some people draw from the body of candles, some people draw at the wicks. It's all these sorts of little tiny nitty gritty which makes a difference. So that already, based on this, if we kind of extrapolated this up, so we kind of had a region which was up, say, a couple of pips, what it essentially means is that people are buying resistance. Doesn't make sense, does it? Alternatively, if they were to put the stop entry order further up, they feel that they are missing too much of the opportunity, and also that it's kind of not so much worthwhile, which it isn't. But it's one of those things where you kind of, by looking in different ways, which this video will hopefully do, you'll be able to understand a bit better. So you put these orders in here, and more often than not, the market will shoot up and it will round off. Now the reason is that you've got a lot of people, as we said, range traders here who are selling. They might be day traders, so they're going to have tight stops. They're going to make their money all the way along here, but they don't want to give any of their previous gains back. So they're going to have a tight stop. So as soon as they're wrong and the market moves outside of this range, they're out, they move on, they've made their money, bounce, and they're looking on to the next opportunity. So you've actually got a lot of stop entry orders. We've also got a lot of stop loss orders also. But you also have these stop hunters, these individuals who will maybe have a small order placed in the market to kind of trigger a reaction whereby all these orders suddenly rush to the market. So so we have a rounding off. So the market will go up and it'll round off. So we draw it to the side just to make it easier. And what happens here is that the market's pumped higher. All these stop loss orders are triggered. So everyone is competing to exit these short positions that they got here by buying up. So that's the momentum that you're seeing from the breakout initially. Suddenly at this high point here, this peak, all stop loss entry orders are completed, and all the shorts who are in the range, who are trading the range, are out of their positions. They're neutral, and they can move on. Now what happens here is that you've also got the stop entry orders who have also competed, and they've been filled. But at this point here, the volume isn't strong enough. There are one or two individuals who go in, right, okay, I'm going to look to either take a small hit or break even, scratch my position on this and move on to the next opportunity. Plus you've got the more significantly, those stop loss hunters usually have much bigger positions that they're trying to get filled. So they know there's a lot of stop loss orders and stop entry orders here. Maybe if they've got 100 lots to put through, they'll put maybe half a lot or one lot just to trigger those. So then as the market moves up, they're actually getting a better selling price for their view. So they've got the short view in line with the trend. They start selling into that, and then that allows the market to move back towards this point. Now with a traditional breakout, what you expect to see is the market come back, retest, and continue on its upward trajectory as we've kind of already announced. But more often than not, the market's going to go back inside its traded range. And this is where option B comes in. At these opportunities here, option B is far more favourable because the probabilities are with you. We know that the majority of breakouts fail, fake outs, so that presents an opportunity. If I saw this occurring here, the first thing I'd be thinking of is, right, okay, the probabilities are against those who are trading breakouts anyway. They're with fake outs, and also it's against the trend. So how strong is the momentum to the upside going to be? It could be the case where this could be construed as a triple bottom, double bottom, whatever. But realistically, we're just talking about ranges in the middle of normal trends. Nothing really substantial. Imagine this is a range that's been continued for a month, and the trend behind it has been lasting for 20 or 30 years, for example, or that sort of time difference, which means that this double bottom is not, or triple bottom is not going to be significant enough to get that sort of move. You would generally think it needs to be a lot longer, the reverse pattern, to be forming. So the market comes back in, and knowing that it's against the prevailing trend, I would actually be looking for short opportunities based on the idea that fake outs occur more often than not anyway, and you're trading against the trend here. So as soon as I saw this market push up here, I'd be looking for long wicks and kind of a lack of volume on the smaller time frames. For example, if this was an hourly chart, you'd be looking for the market to kind of you'd be looking for the market on, say, 15-minute, 5-minute charts to have long wicks, bodies that are quite small, kind of those sort of candlestick patterns that are saying that, okay, the market is trying to push higher, but by the time the candle ends, the market's pushing, the bears are coming in and pushing the market back down. So I'd be looking for opportunities to short into that based on the probabilities there. So that's already a completely different view to those who are trading using the stop entry order method. And as the market comes back inside the original trade range, then there's a signal. The whole signal comes from you're with the trend here. The market's trying to push up again against it. How often is it going to, out of 10, kind of do option A where it's going to aggressively go to the upside? Now, this is under normal circumstances. There are news, for example, that might cause this, but we're talking about just normal trading conditions. Ceteris paribus, so to speak, simplifying as much as possible. And at option B, then you've got the signal whereby, okay, we're going with the trend. We've got a traded range, so we're in the middle of the range. We're kind of around this resistance region where we're going to look to enter. We've already had a fake out, so it shows that the market isn't ready yet to push the upside, and we'd look to short. And then we could, if we wanted to, then look to add to positions based upon a breakout to the downside, which is with the trend, but not using the stop entry order. We'd be looking for the market to pull back and do a retest at previous support, now resistance, and look to add to our positions.